This is the Analysis in Chains with Nathan Williams and Neal Kieran.
Welcome to Analysis in Chains. I'm Nathan Williams. Neal, how are things going on your side of the pond?
It's going good, Nathan. I think crypto spring is upon us. I'm feeling a bit more happier, a bit more enthusiastic after that long crypto winter.
Springtime for crypto in Germany. Anyway. No, it is interesting, given our talk last week about the scandal of inflated volumes in crypto exchanges, how that hasn't seemed to hit crypto, Bitcoin, or altcoins at all. But rather the market keeps rolling on. And it surprised me a little bit, given that some of the volumes were inflated by as much as 90%, even for some of the larger coins. But it seems like the crypto market was just like, meh, whatever, and kept on rolling.
Yeah, I'm not really surprised because in the last few years, we had controversies like US Tether and also BitConnect. And when BitConnect fell apart, crypto just went meh. I think with Tether, there's still lots of question marks, but now people have just accepted that it's here to stay. And people sometimes come around and say, hey, this is fraudulent. And then other people would say, no, actually, it's legit. And have heard Mike Novogratz say that. He met them and, poked around at their business model, and he seems to be happy with it. So we do often have these controversies. And I do think that, a lot of the big time players or whales or institutional investors have their own data aggregators that they would watch and help them understand the markets a lot more. And I think the problem with market volume is more of a coin market cap problem than a exchange problem. Because if I wanted to watch exchange volume to help me understand the market, I would rather go to Coinbase, who I would trust more. So that really puts a lot of emphasis on coin market cap. What are they going to do? And I've started to see people talk about other aggregators that have different ways of determining real market volume. So I can see maybe some new websites coming up because CoinMarketCap hasn't been challenged as being the main central aggregator. And whenever I go on Bloomberg or wherever to get some news on crypto, they often reference CoinMarketCap. So I can see some changes coming in this respect.
When you think about crypto coins, the coins that come out of mining, out of a decentralized system even Bitcoin, for example, where you don't have one group that's in charge of it. Sure, it's maybe not possible to regulate it like a financial entity, but when you're talking about exchanges, you absolutely can. And this is sort of what we've been expecting to come, is further regulation on exchanges, and it's what needs to happen to prevent this sort of fraudulent behavior. Coming from a crypto background, you tend to have a tendency to be a bit of an anarchist, right? You want to see sort of the end of the big companies dominating everything and the rise of the little guy who can then play in this sort of unregulated market and have access without necessarily having to put $1 million down from the beginning, like an accredited investor. But the downside of an unregulated market is it actually lets the big guys have more power because they can do things like inflate the volumes on their exchanges or play with the news and generate fear of missing out without some sort of recompense. So as the financial industry adopts crypto and adapts to this new environment, I think we're going to see the hammer come down hard on some of these exchanges when they have these fraudulent practices.
I totally agree. And I think this is the reality that many crypto people will have to wake up to. Because if you want big institutional investors, particularly those who handle money related for retirement and pensions and whatever, it's very unlikely that they will be dipping their toes in crypto when it's completely unregulated. Whereas in a world where it's more regulated and you're using exchanges that are more regulated, that you're more protected, it means that you can afford to, maybe trial 1% of your funds in crypto. And so if you really want these institutional players to come in, well, you have to play by their game, because institutional investors want the most certainty possible when they make an investment. So if we look at what's happening in the financial world today, you have US 10-year bonds drop down to record lows. Same in Germany, same all over the world. And that's because people are nervous about a recession coming. So everyone's piling into the most safe, guaranteed thing. And in some cases, people are actually paying negative rates for the bond. So they're actually prepared to lose 0.5% of all money they put in. And usually when it comes to bonds, that's the biggest investments in the world. They're more willing to lose 0.5% than actually have their money in equity or anything else, because they think the correction will be 20-30%. So this is the mindset of an institutional investor. And therefore, when it comes to crypto, ideally, all they're doing is investing in assets. They don't want to worry about, say, exchanges and the false information that they're receiving that help them make a decision. So, yeah, this is the way it has to happen. And if you think that you can have the wild, wild west and have institutional investors come into it, I think you're dreaming.
Yeah, probably. And, there's something always exciting about the Wild West. The Wild West days of crypto when anything goes. And I think that we're not completely out of them, to be honest. I think that we're probably going to see a reemergence of new models, of things that haven't been tried, because, in spite of the fact that we came through a crypto winter, and in spite of the fact that a lot of the retail hype has sort of at a low ebb right now, we haven't yet seen projects come to full adoption that have made the best use of all the crypto has to offer. Because by using these decentralization tools, by creating an immutable record of data, by having a completely new incentive model, there's a lot that can be done that wasn't done in 2017. 2017 was all about coming up with a token to run a more or less standard project and attach the name decentralization to it. But ultimately, it's these new business models that require game theory knowledge to think out, that require a certain level of expertise, that once they come into the limelight and they come into the mainstream, we're going to see some real shifts happen.
I totally agree with you. Back in 2017, it was just a token associated with an idea. There was nothing really made, a bit like the dot-com bubble, where there were IPOs and there was no real business model. It was just an idea. And that's what happened in 2017. And what we're now seeing is we're seeing a lot more development. We're going to be seeing a lot more staking, I think, in 2019. So I know Tezos has started to allow staking. I know Cardano's near there as well. And as I mentioned earlier, in a world where there's very little yield in terms of bonds, staking and the interest you get in staking is an interesting alternative. So
now, what do you mean by staking, Neil?
So staking, the way it works is it's like an alternative to proof of work. Proof of work is where you have mining equipment try to break down an algorithm, and whoever solves that puzzle wins a coin, like in the case of Bitcoin and Litecoin. But in terms of staking, what you would do is you would give up, maybe if you have 1,000 of a given token, and I'm going to apply this to staking. In other words, I'm not going to have this in circulation. And if I'm going to put in 1,000, then you maybe put in 10, another guy puts in 10,000 committed towards staking, which means that we are effectively betting on the system of finding a new token. And just say I committed 10% of everything staked and you committed 5% of everything staked, the return will be distributed according to that amount of what we staked. So one big issue is that people often say, hey, this is, if you have a lot of money, you can stake the most and therefore get the most. But hey, this is the same case in mining. We now have, 3 or 4 main mining pools, and they effectively take all of the rewards in mining. So with staking, we're going to be seeing a lot more business models being developed. Like, that's the overall high level assumption of staking. So instead of mining equipment, you could do it on servers. So therefore, there's going to be less energy consumed. But then we have to see if game theory plays out the way many people think it will, and make a more fair system for many people to get involved. Whereas if I want to start mining today, I really am far behind. It could be much easier to get involved in staking, as a newcomer today. So these things we're going to see played out, and I think it's going to be very interesting to see how successful they will become.
I find this sort of conversation fascinating because whenever I hear staking, and I'm thinking proof of stake algorithms, I'm thinking tech, I'm thinking consensus mechanisms, I'm thinking ways of making incentives for the community or for a larger community to keep a system, a blockchain running, right? I don't tend to think of it in terms of a financial investment. And although, of course, it is, right? Because, you stake, you stake coins, you get a reward, and then that stake allows whoever has the most stake to basically make the decision, or to participate in making the decision of which transactions are recorded in the blockchain. And so as a large institutional investor, making a decision to invest in coins is not just about the financial return that you'll get on them by the value going up, by them being more valuable. It's also the return that you will get by staking them and getting certain incentives and block rewards whenever a new block is minted. So, yeah, just the concept of it as a financial instrument that a non-technical entity can get involved with. Yeah, it's a new way of thinking of blockchain that if we want to see institutional adoption, we have to get used to.
Well, if you look at equities these days, if you get an equity without a dividend, it's going to be a bit more volatile. Whereas if you get an equity with a dividend, it is less volatile, and you are really betting on the dividend you're getting with that equity. So in the world of staking, the idea is that if a lot of people are staking, you actually reduce the volatility of that token. And so this is why they may be more interested in it, because there's less risk of a falling 20% when so many people are committed to staking. That means that there's less outflows and inflows into that token. So that's the way I would see staking, and that's why I see it has a lot more potential. And we hear a lot about Coinbase and Tezos, and how Coinbase are going to start offering staking services. So this would be very, very interesting for institutional investors, because if you're able to say, hey, look, if you get involved in our staking program, because I can imagine Coinbase offering this to an institutional investor instead of an institutional investor going straight to Tezos or Cardano, and they will say, hey, you give us the money and we'll give you the return based on these 4 or 5 tokens that you're staking or you're involved in staking. And maybe Coinbase will make the decisions on behalf of the institutional investors. So that's the way I see it playing out, but remains to be seen if that would be the case.
Yeah, I mean, there is obviously one big difference between a staking reward and a dividend, right? In a dividend, you have an entity like a company that brings in money and then distributes some of that money to its investors or to its shareholders. And that's your dividend. In a staking model, you don't necessarily have money coming in, right? You're just creating new coins at each block. And so you're expecting the demand to be more or less constant, or to scale with the supply of coins to keep the price at least steady. So that may or may not play out, depending on what the transaction volumes are. How much do people actually want it? And also what the coin is used for. It's one thing to stake coins, but the question is, can you use them for anything? Do they get consumed by being used within a system? And Yeah, these are all open questions that will vary from coin to coin and from blockchain to blockchain. But it's important to keep in mind that if you're starting to think of blockchain and coin staking as an investment mechanism for your large institutional investor, that there is that fundamental difference there.
I think you nailed it. Well done, Nathan. I can't wait
What do I win?
I can't wait to sign you up as my crypto advisor.
Yay!
But you're right. It's the future. It's going to be very interesting.
I charge 5 Neal coins.
Yeah. I'm really behind on launching Neal coin. It's going to be a winner.
Neal and Nathan coin. Whatever happened to our nutshells? I still have them. I still have them. I made them. I actually saw a few months ago that some people had traded them on the Waves exchange.
Oh wow!
For those of our listeners who weren't with us back in 2017 during the crypto hype, I tried making my own coin, and it was the Analysis in Chains coin, and we distributed some of them to our listeners as rewards for listening to the podcast and commenting and things like that. And we still have most of them. And I did see some people actually trade them for Waves or for Ether, but not in a high volume by any means. And we still have most of them.
So if you go on our Telegram group, you can let us know if you want some, and Nathan will be glad to send them your way.
Exactly. For the low price. Yeah. Cool. All right, Neal. Well, on that note, let's call it a day, and good luck with the rest of your week, and try not to invest too heavily into low volume coins.
I'll do my best, Nathan. There's no guarantee I won't put my house on low volume coins.
Otherwise, it might be a difficult time trading it.